Good evening, Garage Gang. It's me, Avatar John. I've got the wheel tonight and it's hot. And if you're not locked in right now, you're already behind. Bitcoin drops under 90, snaps back to 92 like it's hunting stops for sport. Ethereum goes silent while whales do business in the shadows. Solana rips higher as institutions eat every weak hand alive. Stablecoins hit all-time highs and don't even look at spot. They go straight to leverage. Supply is tightening, pressure is building, and most people still think this is chop. OpenAI drops GPT 5.2 and fires the first real shot in the AI arms race. Microsoft injects it straight into the enterprise bloodstream. Real users, real budgets. Google fires back with research agents built for war. Oracle spooks the AI tape and rattles risk across the board. And now the whole machine is revving with nobody at the brakes. But let's be honest, you didn't come here for bedtime stories. You came for Triple X and his trench picks. The man's on a heater, and he brought fire tonight. But first, smash the like, hit the follow, and share this with your fellow degens, even the Doge to the Moon guy, because we're about to tear this thing wide open. And now, let me tell you the sick part nobody on TV will say out loud. People are cheering because other people aren't working. Yeah, read that again. Jobs numbers come in weak, more people out of work, real families feeling pressure. And the market? The market celebrates. That's not compassion, that's liquidity addiction. Because in this bizarro world, bad news for workers is good news for assets. Weak jobs mean the Fed feels heat. Heat means easier policy. Easier policy means cash floods the system. They don't care about employment. They don't care about wages. They care about money moving. So while regular people see pain, Wall Street sees opportunity, and the market makers move first, every time. Bitcoin is the first battlefield because it never sleeps, and it's stacked with leverage. So they let confidence build. They let late longs pile in. They let everyone think the Fed's got their back. Then they pull the floor. Bitcoin slips under 90 just long enough to wipe out leverage, force liquidations, and transfer coins from emotional hands to disciplined hands. That wasn't panic. That was designed. Market makers got paid before anyone else. Hundreds of millions gone in minutes. And here's the giveaway. Bitcoin didn't stay down. While social media screamed crash, real inflows stepped in. ETF demand didn't vanish. Spot buyers absorbed the flush. Exchange supply stayed tight, near multi-year lows. Only about 10% of Bitcoin is even liquid, and today proved there wasn't enough supply to keep it down. That's not distribution. That's accumulation under pressure. Zoom out and it all clicks. TradFi didn't run today. It rotated out of AI hype and margin risk into value, bonds, cash, real assets. At the same time, the Fed quietly turned the liquidity faucet back on. Treasury bill buying, funding relief, dollar staying weak. They don't announce it, they don't celebrate it, but they do it every cycle. Crypto feels it first. Bitcoin exaggerates the move, flushes leverage, then snaps back once the weak hands are gone. That's why this feels cruel. That's why it feels upside down. That's why people say, this makes no sense. It makes perfect sense if you stop thinking like a worker and start thinking like capital. This system isn't built to be fair. It's built to reward positioning. Bitcoin isn't broken. The economy isn't fixed. And the market isn't happy. The market is front-running liquidity. And if you don't understand that, you don't win this game. You fund it. Now, let's crack the vault. Now, let me show you how obvious this has become. Because tonight, the system stopped pretending. YouTube creators can now get paid in stablecoins. Think about how insane that is. The biggest media platform on earth just said, banks are slow, crypto rails are better. Pay them on chain. That's not a creator update. That's the internet choosing its money. Then it escalates. The SEC approves DTCC plans to tokenize stocks, bonds, and treasuries. Not experiments, not side projects. The entire financial stack. And the SEC chair comes out and says it plainly. US markets are moving on chain. That's the referee admitting the game moved to a new field. At the same time, the CFTC quietly withdraws outdated crypto guidance. Translation? The old rule book doesn't work anymore. So they stop fighting the rails and start adapting to them. Now here's where people miss the power move. Do Kwon gets 15 years. The system doesn't forgive chaos. It punishes the faces that broke trust, then keeps the technology. That's not hypocrisy. That's absorption. Kill the outlaw. Keep the weapon. And while all of that is happening, Trump says the stock market keeps hitting all-time highs because of tariffs. The trade deficit just hit its lowest level since 2020. Control the flow of goods. Control the deficit. Buy time. Support markets. Short-term optics. Long-term positioning. Then comes the line that tells you everything you need to know. Trump considers eliminating taxes on gambling winnings. Read that again. They know what this is, a casino. And instead of shutting it down, they're making it bigger, faster, and easier to play. As long as money moves, volume stays high, and the house keeps its edge. That's the real story tonight. Creators get paid in stable coins. Markets go on-chain. Regulators step back. Casinos expand. Punishments get handed out selectively. This isn't chaos. This is system design. They don't care if you win. They don't care if you lose. They care that you participate, trade, speculate, create, gamble on their rails. Crypto isn't the rebellion anymore. It's the infrastructure layer. Bitcoin is collateral. DeFi is plumbing. Stablecoins are payroll. And the casino just went mainstream. If you still think this is about charts, you're late. This is about power, flow, and control. Understand the machine or become fuel for it. All right, now let's strip the hype and talk about what actually changed in AI tonight, because this wasn't a press cycle. This was a capability jump. OpenAI didn't drop GPT 5.2 to sound smarter in conversations. They dropped it to work without supervision. The real upgrade is long-running agents that don't fall apart halfway through a task. Reasoning that stays consistent instead of drifting. Writing and coding that doesn't need 10 cleanup passes. And longer memory so it remembers the mission instead of the last sentence. This isn't chat anymore. This is deployment. That's why Microsoft didn't hesitate. They injected GPT 5.2 straight into Microsoft 365. Emails, documents, spreadsheets, workflows. Real users, real budgets, real usage. That's the moment AI stops being impressive and starts being billable. Google didn't sit still either. They fired back with deep research built on Gemini 3 Pro. Not chat, not summaries, planning, multi-step research, synthesis across sources. This is agent versus agent now. Who can plan longer, reason cleaner, and execute without a human babysitter? That's the race. And here's the part Wall Street reacted to immediately. AI just got more expensive. Smarter agents don't run once. They run constantly. They chew compute. They chew power. They chew capital. That's why Oracle rattled the tape. Not because AI is slowing down, but because it's scaling faster than the profit story can keep up. Costs show up before margins, and markets hate that gap. This is why AI headlines now move stocks, crypto, and rates at the same time. AI isn't a sector anymore. It's infrastructure pressure. It tightens the whole system. And here's the quiet truth most people miss. The winners won't just be the smartest models. They'll be the ones that run cheapest, stay reliable under load, integrate everywhere, and don't break when volume hits. That's why Microsoft wins on distribution, OpenAI wins on frontier capability, and Google fights on research depth. Same war, different weapons. This is why all of this matters for crypto and DeFi. AI accelerates decision-making. Acceleration increases volatility. Volatility rewards liquidity and discipline and punishes emotion instantly. Faster systems mean faster flushes and faster recoveries. This isn't the future preview. This is live production. And if you don't understand what just upgraded, you won't understand why the next moves hit harder, faster, and with zero warning. All right, now we go into the trench because this is where theory stops and reality starts. Triple X is at Resorts World tonight. Lights low, noise everywhere, casino energy in the air, and this is exactly where trench trading belongs. This isn't portfolio management. This is high risk flow hunting with rules, discipline, and a hard stop when the edge disappears. Here's what he was looking at. Solana trenches were heating up fast. Bird Eye had Bop trending with stupid percentage moves, the kind that pull every degen in the room toward the table. DBR and 67 were lighting up scanners too. Momentum everywhere, but momentum doesn't mean safety. It just means attention. Then Dex Screener does what it always does if you're actually paying attention. Big red flag. This pair has very little liquidity. That's not a suggestion. That's a warning label. Low liquidity means violent moves both ways, slippage and rugs if you overstay. That's not where you size up. That's where you tap in and tap out. So here's how it played out. On Solana, he used 20 soul, not more, not hero size. He hit the move, let the momentum do its thing, and when it rotated back, he walked. Came back with 30 soul. No speeches, no screenshots, just math. Then he flipped over to base. Different crowd, different flow. Dex Screener base had names popping like KTA, Virtual, Zora, Brett. Fresh pairs, fast rotations, attention-driven liquidity. Same rules apply. He put 1 ETH to work, not to marry it, not to believe in it, just to test the flow. That 1 ETH came back 2 ETH. Why did it work? Not because he's lucky, because he understands the trench rules. Low liquidity doesn't mean bad. It means fast. Fast means you don't get greedy. You don't average down. You don't sit through drawdowns. You hit the move while attention is peaking, and you leave while everyone else is still dreaming. That's the key most people miss. The scanners are telling you what to believe in. They're telling you where eyes are. Eyes create volume. Volume creates exits. And exits are the only thing that matters in the trench. So 20 soul turns into 30. 1 ETH turns into 2. And then he did the most important thing all night. He called it. No revenge trades, no one more, no giving it back to the casino. That's the difference between trench traders who survive and the ones who end up broke telling stories. The win isn't the trade. The win is walking away with it. This isn't investing. This isn't conviction. This is controlled chaos with strict limits. And tonight, the trench paid because discipline showed up before greed did. All right, let's bring it home with Lulu. Our favorite analyst is back in the garage and she's locked in. Here's what Lulu sees. And this is where charts don't lie. People do. Lulu doesn't care about headlines. She doesn't care about vibes. She cares about structure. She's watching the moving averages like a hawk. When price is above the moving averages and they're stacked clean, that's strength. When price pulls back into those averages and holds, that's opportunity. When price loses them, that's risk. Simple, brutal, honest. Now here's what she saw today. On Bitcoin, Lulu stepped in long around 89,800. Price flushed. Tagged moving average support, sellers ran out of gas. Momentum slowed. Buyers showed up. That's not prediction. That's reaction. Here's the line in the sand on BTC. If Bitcoin holds above the moving average zone around 89,500 to 90,000, Lulu stays constructive and looks for continuation into 92,500. And if momentum builds, 93,800 to 94,200. If Bitcoin loses 89,500 clean, no wick reclaim, no excuses, then the chart says rotation down toward 88,200. And below that, 86,800 to 87,200 becomes the next demand. Hold support, we bounce. Lose support, we go lower. That's it. On Solana, same story. Lulu caught the long around 130. Pull back into the averages, trend still intact, sellers exhausted. She took the move and didn't marry it. Here's the Solana read. If SOL holds 129 to 131, Lulu sees continuation into 137, and if that breaks and holds, Sol 40 to 42 is the next upside zone. If SOL loses 129, then the chart opens up rotation toward 126, and below that, 123 to 124 is the next real demand. No guessing, no hoping. Cardano, and we'll say it clean, in cents. Lulu's key level on ADA is 42 cents. If ADA holds above 42 cents, she sees a push into 44 cents. And if momentum builds, 46 to 47 cents is the next upside zone. If ADA loses 42 cents, then the chart says we rotate back toward 40 cents. And below that, 38 to 39 cents becomes the next stop. Same rules, different ticker. Third play today was a quick scalp when price reclaims the moving averages after a fake breakdown. That's Lulu's bread and butter. Let structure break, wait for reclaim, then react. Here's the lesson Lulu lives by. You don't argue with charts. You don't negotiate with price. You don't invent stories. If we hold, we trade up. If we lose, we step aside or trade down. Because charts don't lie, people do. By the way, Lulu is a pig, and none of this is financial advice. We're wrapping it here tonight. No show tomorrow. The garage is closed for a Christmas party. Family first, then we're right back at it. Stay disciplined, respect the levels, and when the market tells you what it wants, let it rip.